Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by CUSO, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Mark Ritter, CEO of Member Business Financial Services, a Pennsylvania-based CUSO, estimates that about 800 U.S. credit unions do member business lending, meaning that perhaps 3,700 don't. Many more could. That's spelled out in H.R. 1151, the law that lets credit unions serve more than one employer group. Tucked into that law is language pertaining to member business lending. A passage of the law, by the way, is detailed in CU 2.0 podcast episode 51 with Mark Schaefer, then the CEO of Truliant CU. Now back to member business lending. If credit unions can make small business loans, why don't they? That's a question Ritter asks and answers in this show. It's also very clear that he believes credit unions and their members and communities would be better served if more credit unions jumped into member business lending. The need on the part of small businesses is acute. Many are turning to non-traditional lenders who may charge as much as 40% APR. Credit unions can play an important role in helping their communities' small businesses, says Ritter, and that will help their communities too. Understand also that a CUSO like MBFS, and it has several competitors in the space, may source the loan, it will underwrite it. MBFS will say if it thinks the loan is a definite yes, a definite no, or most likely a maybe. And if it's a maybe, MBFS will relate the pros and cons of issuing a loan. The credit union provides the loan capital. It makes the final decision on the loan. It sets its parameters of what it will lend to and what it will not lend to. And then MBFS does the heavy lifting on each individual loan. In the show, Ritter offers his unfiltered outlook for commercial real estate loans and also predicts a bump in delinquency rates. And yet he's bullish about member business lending in general. Ritter, by the way, has his own podcast. There's a link to that podcast in the show notes. Tune into it for deep dives into member business lending. Listen up. Oh, I enjoyed, by the way, your show that you did with Todd Harper. I've done shows in the past about 1151, so I knew about that. I didn't know the member business banking link to 1151.
Yeah,
that was all revelatory to me.
And I have told people that was the best and worst thing ever for our industry, because before 1151, there was probably 15 or 20 credit unions nationwide that did business lending. And it just was one of these things that didn't hit the radar for people. But once they put the cap in place, all of a sudden it spurred people getting into business lending.
Right. In a way, it was a green light. They said, oh, wow,
yes,
we can actually do this.
Yes, before it was basically left unsaid. Here in Pennsylvania, almost all the business loans that were done were Amish loans with the Amish credit union, and that was it. And it was just one of these things. Well, you could do it, but we really don't regulate it, and it's out there, and that's, you're right. That gave it the green light to say, oh, you can do this up to this much, and then it became the wave of CUSOs being formed. There was a whole wave of CUSOs kind of formed in the same era. And then people said, oh, not only can I do business loans, here's a way to do business loans that's a little bit easier for me. Because when I started in credit unions in 2001. And I like to say, it was basically the Wild West, Lewis and Clark for getting business loans done. You just had to figure it out. There was nothing.
Now, how many competitors do you have, CUSO competitors, in the member and business loan space?
I would say for people like me, I think there's probably about 15 or so of us, and that number is stretching it. Probably in people that are my size, we probably have about 6 to 8, and there's several very small people around the country that maybe just work with a handful of credit unions in their neighborhood, not that big, but there's probably about 6 to 8 of us. And it's really a business that you have to have scale to make it worthwhile. It is because the investment on the front end is brutal in today's world with software costs and people costs, and you have to have a base of clients. Otherwise, you're just losing money for years. And going back, I've looked at an article from about 15 years ago of when all the CUSOs started working together, and there's only half of us that's still in business. So there's even really been a consolidation of this time, and some people have gotten into it and say, no, we can't make money doing this, or we can't even break even. So that's why I think you've seen the market mature a little bit to a couple people who have the scale to stay in it.
Well, there's also more non-traditional lenders coming into the small business lending space with very high interest rates, but they're willing to make riskier net loans, I suppose.
Oh, typically they average in the high 30s and for close to 40%. And it got to the point where they couldn't price for risk because once interest rates skyrocketed and these rates started going up in small businesses, I mean, the people who took those loans weren't the greatest credit quality to begin with. And you had these people, anybody who could steam glass with their breath could get a loan, and then it just spiraled, and you've seen even a lot of them go out of business, because of liquidity, the interest rates increasing, and just that softening of the small business space. So it is
And also, those guys did not have the organized crime muscle that in past generations could collect on the loans, or at least the
yes.
shred of the muscle would create collection. Whereas
Yeah,
these guys didn't have much of anything really in that regard.
when you're getting a fintech loan online, it's not like you said, even the local bank or the local lender who's knocking on your door saying, "Give me my damn money." What's going on? You really you don't have a affinity or scare that somebody's going to be coming after you.
Yeah, when I was a kid, every factory in New Jersey, probably in Pennsylvania too, had a loan shark.
Absolutely.
Yeah, this was the so-called 5 for 6 man. He'd give you 5, and on payday you'd give him 6, which was a hell of a good interest rate. It's but that they were those guys were omnipresent in factories. Often it was one of the workers or a foreman or something, not necessarily a guy working full time on that. But
my father was a union electrician for years in the coal region of Pennsylvania. He has told me the stories of once in a while when he had to go and pay the bills back when we were younger. He would walk in and just stacks of cash and guns everywhere.
well, back in those days, there were very few places for your father to go and get loans. I know that because I'm older than you, but my father had very few options for getting loans. So
yes,
even if the car engine blew up, it wasn't a clear-cut way. You went to like beneficial finance or household finance, both of which were legitimate businesses, but they charged pretty high interest rates.
Particularly where I grew up in the ethnic communities, where these were closed communities where people worked and stayed within their network, and they did business within their network in their community and ethnicities for better or for worse.
Now, how many credit unions at this point have what you would call a serious commitment to doing member business lending?
So I have actually do this data, and I consider somebody who's into business lending if they do one loan every other month. I've kind of set the
Whoa,
I've
that's a
kind of
low bar.
I've set that bar at 6 loans a year. You're right. That's a pretty low bar. And that is about 800 credit unions in the entire nation that fit into that. And if you actually throttle it up, you're to a pretty good volume. You're talking into maybe 100 and a quarter, depending on how you define that. And that number of 6 loans, that has not moved at all in the past 10 years. You're seeing volumes of business loans really increase. It keeps going up, up, up at a nice steady pace, but it's very concentrated among those top 150 credit unions. You're not seeing the depth that I think it should. And it really just that's disappointing to me. I really think that we need a deeper bench in credit union business lending, because it'll help the smaller and mid-sized credit unions survive. And I think also those small and mid-sized credit unions, hey, listen, I have a lot of friends at really large credit unions, but those small and mid-sized credit unions have a much better touch neighborhood-wise in their communities. So I think it's a win-win, but people continue just to stir the pot at it.
Why would a $500 million asset credit union, which if it's reasonably well run, would have the liquidity to make some business loans? Why would it say, no, we're not interested in that business?
I think what the biggest issue becomes fear. I haven't done.
Well, that is the worst 4-letter word in credit union speak. It's you go into the boardroom and you say, what's the dirtiest word? 4 letters, fear. It's
I haven't done that. I don't do that. I once had a credit union CEO look at me and say, I have another 10 years of my career. All I want is for nothing to happen. We want to keep it. They would rather, I call it management by avoidance, rather do nothing and have nothing happen in that area than, okay, you do 10 years of loans and you have one go bad and everybody makes a big deal about it.
That's another thing credit unions do that drives me nuts. In the fintech world, the motto is fail fast. Built into that is there are going to be some failures. They're going to be. And the credit union, they want a 0 delinquency rate, a 0 foreclosure rate. These are not realistic goals.
Small business lending I cannot think of another area where people are so proud not to do well. People will, oh, no, we don't do small business lending. No. Well, guess what? Your members do. You would never say that about auto loans. Oh, no, we're not good at auto loans. We're not good at mortgages. But for some reason, people give themselves a pass and sometimes look at it with a badge of honor to avoid this segment of their community and their members who need the financing, who need their help, who are looking around and have hopes and dreams and create jobs. And we just give it a pass at times. Now there are, like I said, there are some people that do it great. I have some people that do it great. But if you look at the call report numbers, you're looking at over 3,000 credit unions with 0 business loans on their books. That's a crime.
And I've talked to CEOs of decent sized credit unions in rural America. I've asked them, would you, a member of yours is a farmer, a member wants a loan to buy a tractor. Tractor's going to be six figures. Would you make the loan? No. And because we don't do farm loans. I said, well, that's kind of like a car loan. It's just not a car, it's a tractor. It's not still wouldn't do it. And the mind is just closed on that.
I just did a podcast episode with Phil Love, who runs a CUSO in the Midwest, and they are very heavy into ag loans because of their location and credit union base. And I talked a lot with him about it, and it we're talking about such a crucial industry in America. And we're not talking about an elitist institution. This is the industry that feeds America, that feeds your members. That's
And everybody's complaining about the death of
yeah,
the family farm, the death of the small farmer. And I view that as tragic myself. But these are the very people who often need to borrow a little money to buy that
yes,
new tractor.
yes,
The mega company that owns half the land in Kansas, they have financing ways. They
yes.
know how to raise money.
Yeah, and it's a shame because this is, we talk about community-based financial cooperatives, and this is the communities that you're in, but we sometimes segment them off and say, "Oh, we can't do that." We have this community charter. We're here for open everybody, but we lop off certain segments and of people who you'll give them car loans. You'll give their family car loans. You'll give the people who work on the farm financing. You're in bed with the farmers in your community, whether you like it or not.
Well,
So
so if you want that guy to pay off his car loan, it would help if you keep his business growing. I mean,
yeah, absolutely. It's mind blowing on why we can't get people to look at, drive around to your neighbors, drive around to your towns, particularly for these people that have a community charter or are within a pretty tight segment. And yeah, there's going to be some things that you can't do everything to everybody at all times. But this is pretty commonplace of the businesses in your community that need funding and helping them out and helping them grow. It's
well, I
time
also
that
I
people
think of
step up.
equipment
Yeah.
loans. It's basically a car loan. You can repossess a tractor.
Yes.
Uh, it
They hold
happens.
value.
And it's predictable value if it's a name brand. If it's a John Deere tractor, I don't know who the big tractor makers are, but if
Yeah.
it's a name brand, it will hold predictable value. So it's not a crazy loan. Now, tell me how your business is structured. The credit
Sure.
union member of the CUSO puts up money for the loan. They fund the loan. What do you
Yes.
do?
So we are not a direct lender. So when you get a loan, nobody's getting a loan through MBFS. So we are the life cycle is that we have a team of lenders out there that work with the credit unions in a region, and they either get referrals from credit union members or they're kind of pounding the streets, knocking on doors, looking for prospects. Or we do have a base of credit unions that do that function themselves. And once you have all the interviews and gathering financials, and this is what we're due, so we'll take that loan and underwrite the loan and give them a package that says this is clearly a yes, this is clearly a no. But most of the time we say, okay, it's somewhere in between. If you're going to do the loan, here's things to consider, here's conditions to get done. So once they make the decision on the loan, then we really are that back office that helps people close the loan. We help out with the appraisals. We have a loan doc system, and then we have a servicing platform too because a large chunk of our portfolio is participated out among credit unions of them working together. So, I kind of like to think of us as that whole back office operations. We are that front end member facing situation for a chunk of our loans. Think of us as kind of that back office chunk, doing the X's and O's to support the whole commercial lending process. And we get paid, similar to an attorney office. It's okay, we did this service, it cost this much money. And most of the time, that's passed through to the members on their balance sheet. And but really, also what we'll do, and this isn't the money making piece, but just really kind of being there for the credit unions on, I'm having this situation. How do I help it? We help them get started with good policies and help creating credit culture. When the NCUA's there, we're having this working with them side by side. But our revenue sources are those fee for service things like the underwriting, loan origination, documentation, servicing. Our servicing portfolio right now is just a little over $3 billion, which is right in line with just about any CUSO out there in the country.
So, to go back to where I started, the credit union basically needs to have some money that it's willing to lend.
Yes.
And that's essentially all they need to do.
Correct. And back in the old days of the CUSO world, you used to be able to point at the NCUA would come in and say, I have questions, and you point at the CUSO and say, go ask them. Now, you don't have to be an expert in commercial lending, but you have to understand what's going on the books. You have to be able to understand the risk and how it fits into your risk profile. You don't have to know where to place every number in spreading software. That's our job. But
each credit union has the opportunity to set its own underwriting standards.
Correct.
Like, I do not want to do marijuana business loans, for instance. Others will say, we really send all the marijuana loans our way. That's fine. It's up to each credit union. And I assume that's the way all your credit union members, that's how they work.
Exactly. People always ask me, well, do credit unions do this? And usually within our block of credit unions, somebody's doing something, just about everything everywhere. It's not a fit for everybody, but that's the nice thing with a CUSO is, we can move businesses around to somewhere where it fits.
And you bring some of the business to the credit union too, from what you said. Correct.
Commercial lenders are a real pain in the ass. They make a lot of money. They're tough to manage, and when you throw them into a credit union, sometimes it really throws off the dynamics. So that's why.
Well, I talked to him. I'm sure you could actually. I'm sure you remember the exact situations a couple times in recent years, not super recent, a few years back. Credit unions have bought often a small bank, and you ask, why do you want the bank? And it's the commercial lending department. You check with them like a year later and you say, how's it going? It's not going too well in most cases.
No.
And so those relationships didn't translate from ABC Community Bank to the credit union immediately, which is what the credit union people thought, even though the people transferred. But maybe the relationship was actually not with the lender, but with the president of that community bank. Maybe that's the guy you played golf with on Saturday. That's kind of what they were missing.
I always people always ask me about hiring lenders. And I'll say the worst hire you can make is the 30-year veteran who says, all my people are with me and I've never made a bad loan and I have a loyal base of people. Because I can tell you that guy hasn't originated a new customer in probably 15 years. And the other piece is just because he has a particular type of customer doesn't mean you want to do that. You want what I call the young and hungry, people who are out there working the streets, working with businesses. You form those relationships in the community, and you keep hustling.
Who
Yeah.
needs the loan? It's the 35-year-old small business person.
Yes. It's
And
it's not it's
and
not the
he's more
person who's
likely to
doing
deal
nothing.
with the lender who's 35 or 40 years old too. I mean, it's a generational thing.
Exactly.
Nothing wrong with that. Now, I listened to one of your recent podcasts, and you said that you had concerns about delinquency rates rising, not to a critical point, but actually, if I remember what you said essentially the delinquency had been at zero for
Yes.
several years. So a 1.5% delinquency rate looks like an explosion, which mathematically it is. So, are you still thinking that way?
Yes. And I remember every presentation I did in 21 and 22, I told people your delinquency is zero. You're not as smart as you think. It's just that liquidity is swimming everywhere. People have been given tons of money. Rates, you're doing these commercial loan rates at 3%. Well, at 3%, just about any idiot can make a loan work. Once rates rose, the we found out who the weak people are to historically normal rates. Everybody's talking about, oh, rates are high. Doing rates at 6.5%, 7% is just called life, and that's pretty normal. So we've seen this continual bump in delinquency. How many loans did we do in 21 and 22 to these huge office buildings? And they were all done on 5-year rates. So 5 years from now is going to be 26 and 27. So look out. Look out. It's, I always say the bigger your market area, the bigger loans, the bigger problems you're going to have. In smaller market areas, smaller size loans that are more steadier, we're really not seeing a bump in the road. These big loans in big cities, it's a mess. And next year and the year after, it's going to be worse. And a lot of people, these originators did these loans and sold them all throughout the community as the best loans. And at the time, everybody said these are the best quality loans out there, these office buildings. And now, the piper's going to have to come due, where the valuation and occupancy just isn't holding up. So I think we have another couple years of this shaking out. Typically, when credit unions have had delinquency cycles, it's been very concentrated. What I'm seeing now is delinquency much deeper than we've ever seen in the credit union industry.
Well, explain that.
Back in the Great Recession, we had the Miami condos, we had the California condos, we had church loans. And really, when you looked at it, might have had 10 or 12 credit unions involved in that.
Well, I go back to the S&O crisis in the late 80s. That was essentially 10 S&Ls or thereabouts. I'm not saying more didn't have a fingerprint on it, but there were Lincoln Savings, for instance. There was just a handful that did the majority of those loans.
And you're seeing, but now in the credit union space, you see a lot of people who either they bought into loans. The big originators sold billions of loans a year as participations, or they just did it themselves. And there was a lot more credit unions out there doing these larger office buildings because it's easy work. It's much easier, as a lender to do a $6 to $10 million loan and go play a rounds of golf than bust your hump, doing $300,000 to $500,000 loans to small businesses. And that's what a lot of people did. But
the commercial, the office building market. I live in Phoenix, and the office building market here And I'm just saying this from what I see walking around. It has to be horrendous.
Yes.
I could show you two or three vacant, reasonably new buildings within a mile of where I live. And they're just sitting there, falling apart, you know, and broken windows, blah, blah, blah. I mean, they're just waiting to be torn down, I imagine.
I almost think at some point, there's a few buildings that can be converted into residential. We have an inherent lack of housing in this country.
That's a really expensive proposition.
But it's very expensive. And many times, because of ingress and egress in the elevators, it's just not possible.
Well, there's a BMO, a beautiful BMO, Bank of Montreal building, corner of Camelback and Central, prime real estate. And that's been in the conversion process for at least a dozen years. I think it's gone bankrupt twice. So I think ownership changed and went bankrupt again, if my memory's right. Construction seems to be stalled yet again. It'd be a beautiful apartment location. It really would be. But it's not just the elevators. It's also things like there tends to be like more limited water stacks. So how do we get water to the corner apartments, which will probably cost more in the first place, and they kind of are going to expect water. It's stuff like that. So it's not a. I wish it were easy to do because it would be a magic wand, but it's not.
It's not. And many people, I had one of our credit unions. They had a building, single tenant, national public company, and they emptied out the building, and the building literally got bulldozed over, trying to build a retail and residential complex. Because people are just trying to do anything they can to turn these just dogs that are going to be dogs for decades if they ever come back, and make them possible. And I say this as somebody realize I'm sitting in my home office to a completely virtualized company. I don't think these white collar jobs are coming back to big city or office park skyscrapers.
How many employees do you have?
60.
60. And so they're all virtual. There's no office that they can go to.
We have an office. If somebody set off a bomb in our office, there would be no casualties. We have somebody go in twice a week to check the mail and see if anything else is goofy is going on. I go there maybe once every 2 months, and usually I'm in there for an hour, and that's about it.
Now, do you have any members of your CUSO that are still actively doing commercial real estate loans?
Commercial real estate, absolutely. Office is office is like doing Miami condos in 2008. That business is dead.
Or doing today. I think Miami condos are pretty slow on the market right now.
Yeah, and now also, but keep in mind, that one of the big factors is work from home. And what I find is in our small cities, in our third tier cities, work from home isn't as big of a deal. These towns where you can drive from one end to the other in 10, 15 minutes, it's not an issue to call your people into work because they can drive into work, they can go home for lunch. It's not a big deal. So we're seeing small towns, small cities, mid-sized loans. They're still doing these loans, and the performance is great. But if my wife used to work in Center City, Philadelphia, in a big tower, and it took her an hour and a half, and people just said, "I'm not doing it." So those are the areas where traffic is an issue. You're in these big areas. It's the white collar laptop class, who says, "I'd rather be from home." For me, it's more of a business decision on the work from home, because I can hire people in second tier cities who are great and have a ton of experience, and I can pay them a nice salary, where there's not a lot of competition for jobs, and they love it.
Now, a few minutes ago, you mentioned loan participation. Is that still a big part of your portfolio?
Yes. Yeah. And we're seeing last year, the commercial loan participations and participations in general couldn't get any lower. This year, people are calling us up saying, what do you have? What do you have? What do you have? And it comes down to two areas. The first is they can't, all these other loan segments are just dying, dying at the vine. Uh, Cars are okay, but they're not at the pace that they were, and they pay off so quickly. And there's no source coming in to replace it. And even the mortgage business is slow, and a lot of those consumer loan areas are slow. So people are looking at us just because the business lending area tends to be more consistent, but also the liquidity's back. Last year people just said, I'm squeezing every nickel I can. We're not doing commercial lending just because I'm trying to save every dollar for internal people, for car loans and credit cards and the like. Liquidity's back, and there's not many other sources. So, our business is as good as it's been since 2022. And, we're not quite at that level, but it's pretty damn good.
Well, the home mortgage market is very slow. And
Yes.
from what I'm reading, the automobile market isn't particularly robust. So there should be some money floating around available to lend.
Yeah, and the one nice thing about the business lending area is it peaks it peaks a little bit, but generally it's very consistent. There's always businesses looking for capital for their businesses. There's real estate investors looking for deals. So when rates are going up, we stay particularly busy. When rates are going down, we're a little bit busier. And so it's usually pretty solid demand. And most of these loans are written on 5-year loans, so every year about 20% of the market is coming up with opportunities.
If there's liquidity, why are credit unions interested in participation rather than sole ownership?
Because they're looking for demand, they're looking for opportunities, because the property values are still fairly elevated. And what you're also seeing is a generation of credit unions that are finally having concentration risk and have to sell off because they're reaching their regulatory caps. They're reaching caps to one borrower. They're reaching just general diversification. So people are selling quite a bit more when they could finance this whole loan internally, but many times they can't or they shouldn't just because of risk management. Because credit unions have been in this while now, portfolios are maturing, and people always thought, oh, we have this 12 and a quarter limit. Yeah, I'll never get there. Well, they're getting there.
Now, tell me about a cap on amount of a loan to an individual borrower. What is that?
Generally, for federal credit unions, it's 15% of net worth. So if you have a $1 billion credit union and they have 70 million net worth as the bare minimum, you're talking 15% of that. So, they could do loans up to 12, $13 million in range, which for most credit unions is they could finance a city block for that in some of these markets.
Right, right.
If you're in DC, New York, that's not an enormous property, but it's a lot of money. So really, we don't see too many people who regularly want to fund up to that limit. They might go there for more. And when people hit that limit, it's normally a group of loans rather than an individual loan, because, that white knuckle number at 15% of net worth for an individual loan is a big, big loan for most credit unions.
Right. And they are very risk averse people.
Yes.
So better to spread this around, I suppose. And
Yeah.
also the mechanics of participation, there's a lot of automation there. It's a lot simpler and easier to put together a participation deal today than it was 15 years ago. 15 years ago, you had to get on the phone, call the CEO of XYZ credit union down the street, say, hey, you want a piece of this? It's
I mean, we at Members First, when I started out, we were literally doing these on a spreadsheet. And like every loan was a manual process. And now, like you said, buying and selling is a little bit easier with transferring data back and forth. Calculations on servicing is a little bit easier. So technology has really helped out on that piece.
yeah, this is a generational thing, man. When I started, you did it on an HP calculator.
Yes.
The spreadsheet, Excel, Lotus, man, this is great. Woo, this is
Yes.
futuristic. So what's your plan for the business over the next 10 years?
I would really like to see a flattening of our head count. And I think we can keep our costs down by focusing a lot more on automation. It's business lending compared to mortgages and auto loans. It's not a standardized product. And business lending is always the last bastion and area to automate because it's not a simplistic linear process. So I really think we're going to focus on that piece. And the other piece that we're focusing on is going deeper into credit unions. We work with Inclusive, and who's the trade association for CDFIs.
Kathy
So,
Mann has been a guest on this podcast 2 or 3 times.
okay, yep,
National Library. She's a great person.
yeah, yes, they are, and they have a great organization. And I think by working with a lot of those credit unions now, I think they're going to grow. Some of them will get gobbled up, but some of them will grow into be the mid-sized credit union for the next 10 years. So we're really looking at diversifying our base. We even work with credit unions in Puerto Rico now on helping them out with business loans. We have a couple natives of Puerto Rico who help us out and keep things going. But I also
So
I think
you can do business in Spanish.
exactly.
Cool. That's very cool.
And just to clarify, the person you're talking to can't do business in Spanish.
Right. No, I'm talking about your company.
But the
Uh,
company, yes, we
it's,
can.
yeah, I've talked with smallish credit unions in Texas that were doing business loans in Spanish. It's because the borrowers they wanted the documents in Spanish.
Yes.
And I
Yeah, we have all
understand
that.
that. I'm not going to sign a real estate contract written in French. No way, no how. It's so so I understand your primary language is what you want to sign a business document in.
Yeah,
Cool.
but I think we'll continue. I think there's just like there's a consolidation in the credit union space. There's no way all of the people who support businesses will be able to survive. So I really think we're going to see a consolidation and shrinking down, or at least I hope so.
Are you looking to adopt more AI tools?
Yes. Yeah, we're very deep in the Copilot as our walking entry point. And really it's, we're trying to figure out that way to implement an automation and keep our headcount down. And I think my strategy is I want to use AI to to keep the simple things moving and pay our expertise people who are experts to be the artists working with the complex issues.
Well, at the event you were at in Ashland, Steve O'Donnell from One Nevada, he's done some marvelous AI implementations at that credit union. But
Yes.
it's routine back office stuff. It's not customer and member interface. It's not anything glamorous. But this is nuts and bolts stuff that someone has to do, and AI does it really pretty well, he's finding.
Yes, absolutely. And many times, what we find is that the money and products are really put into the consumer side to start out, and then they tend to bleed over to the business lending because it's the business lending, it's fewer volume, there's fewer opportunities, and it's less standardized.
Well, MIT has been doing an ongoing survey of very big companies using AI. 90+% of whom are reporting, last I looked, extreme disappointment with the results. But MIT also points out most of them are doing customer-facing stuff that's kind of glitzy and creative, rather than doing the kind of back office routine stuff that Steve O'Donnell's doing at One Nevada. AI is getting smart, but it's not necessarily going to write you a beautiful TV commercial at this moment in time.
No. I look at AI for the next several years as a intern with a lot of energy who you have to review their work.
True, but you have to redo most people's work, man.
Yes, people have to redo my work. So
I've always needed a good proofreader because I'm a good writer, but a sloppy proofreader. Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey. Again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.